Before you start day trading, you should be aware of these 5 key rules that could restrict your trading or even freeze your account. Rule 1. The Pattern Day Trader Rule. In the US, if you place 4 or more day trades in 5 business days using a margin account, you're labeled a pattern day trader. That means your account must maintain at least $25,000, or your broker can restrict your ability to trade or hit you with a margin call. This rule doesn't apply to cash accounts, but remember, these come with settlement restrictions. Speaking of cash accounts, here's rule number 2, settlement rules, applying to trades executed on US exchanges. These determine when funds from a trade are available to use again. As of May 2024, US stock and ETF trades now settle in T+1. That's trade date plus 1 business day. If you use funds before they settle, you could trigger a good faith violation. Do that too often and you may face account restrictions or even temporary trading bans. Rule 3. Margin calls. Trading on margin means borrowing money from your broker to increase trade sizes, and that comes with responsibilities. If your equity drops below the broker's maintenance margin requirement, often 25 to 40%, you may get a margin call. For example, let's say your equity drops during unfavorable market conditions, negatively impacting your positions. If you don't deposit funds quickly to bring your account back up to the required level, your broker may liquidate your positions. Always check your broker's specific margin policy, as they're not all the same. Let's take a look at how a margin call may work in practice. You invest $5,000 into a live account and borrow a further $5,000 from your broker. That gives you $10,000 in total buying power. You decide to buy 100 shares of Company A, which is currently trading at $100 per share. Your broker requires a maintenance margin of 40%, which means your equity, your money, not the borrowed amount, must always be at least 40% of the total market value of the investment. So, when would a margin call happen? Based on the minimum market value requirement, a margin call could be issued if the market value of your holdings drops below $8,333.33. This translates to a share price of $83.33. So let's say that after trading for a few hours, Company A's share price falls to $70. That means your 100 shares are now worth $7,000 in total. Since you still owe the broker $5,000, your equity has dropped to $2,000, which is only 28.6% of the current market value. That's well below the 40% maintenance margin. At this point, your broker may issue a margin call, asking you to top up your account. To bring your equity back to 40%, you'd need a total of $2,800, which is 40% of $7,000. So you'd need to deposit $800 to cover the shortfall. Rule 4. Leverage limits. Leverage refers to the amount you can borrow as a multiple of your cash outlay, known as margin. Different countries have different limits on how much leverage you can use. In the US, for example, retail traders can trade up to 50 times on major forex pairs like the euro-dollar pair and 1 to 20 on minor forex pairs. In the EU and UK, the European Securities and Markets Authority limits leverage on majors to 1 to 30, while assets like stocks are much lower at 1 to 5 due to greater volatility. The same caps also apply in Australia. Some offshore brokers offer sky-high leverage of over 1 to 1,000, which comes with huge risk to your capital due to the size of possible losses and weaker regulatory oversight. Let's check out an example of a euro-dollar trade under tightly regulated conditions. Let's say you trade the euro-dollar pair, believing that the euro will strengthen against the dollar. At a 1.1000 exchange rate and $1,000 in trading capital, 1 to 30 leverage would mean you control a position that is 30 times your capital, $30,000. The exchange rate moves in your favor by 1% to 1.1110. Your profit would be $300. But you must remember that leverage works both ways. So if the exchange rate moves against you by 1%, your potential loss would be $300. And finally, Rule 5, broker-specific trading rules. Even if you're following regulations, your platform might have its own restrictions, such as trade frequency limits, scalping policies, or asset restrictions. Scalping refers to very short-term trades held for seconds or minutes. And certain brokers, such as market makers or dealing desk brokers, may restrict trades to control order flow. We've seen some MetaTrader brokers outside the US, for example, prohibit trades closed in under 1 to 3 minutes. Some brokers may also prevent trades on meme stocks or cryptos, or halt options trading during extreme volatility, as we saw in GameStop and AMC in January 2021, notable for day traders who aim to capitalize on large price swings. Make sure you check these before registering with any broker to avoid any surprises down the line. Remember, these aren't just best practices. These are important rules that can delay or block your trades. Make sure you understand the legal and broker frameworks in your jurisdiction before starting. Thanks for watching. Hit that subscribe button for more trading insights.